first company we're looking at is Synopsys. Bit of background: what is Synopsys? Synopsys supplies electronic design automation software that engineers use to design and test semis. It leases IP that can be used as a platform to design semis. So basically, offers service and software necessary to develop semis. Getting into the financial performance of Synopsys, you will see that number one, its margins are pretty stable. Highlights that Synopsys has a very mature business model. The margin you will see is slightly below the industry average, which is 18%. However, we'll need to analyze other metrics. So just because it's below, it's actually only slightly below, but just because it's below doesn't make Synopsys a bad company. All right, moving on. You will see the cost of growth is very minimal. And again, this does make sense considering that Synopsys' entire business model is offering silicon as a software. So basically offering its IP and its systems and its software to customers so that they can design their own semis based on Synopsys' IP as well as systems and software. So marginal growth in cost of revenue does not spend that much, when compared to the traditional semi manufacturers. Below the industry average. Industry average is about 9%, so it's below the industry average. Pleasing. R&D has been increasing significantly upward. Now, this again makes sense. It is expected, considering that Synopsys spends on R&D, so its customers does not have to spend on R&D. So it's above the industry average, which is about 10%. It's at 12%, but again, that is expected, so that's not a train smash for me. Going on, as a percentage of revenue, R&D as a percentage of revenue is at 20%. As a percentage of revenue, sorry, it's at 35%, where the industry average is 20%. It is expected, considering innovation will drive growth and profitability for Synopsys, and clients will obviously demand cost-effective and innovative solutions. So again, Synopsys spends on R&D, so clients don't have to. But I do expect an above industry average spending on R&D. That is justified. Spending does appear to be justified, considering that Synopsys is returning on average compound rate of 10% over the past 3 years in revenue growth. The industry average is 8%, so costs are justified in driving growth and profitability when you consider that net income is growing at an average of 31%. So net income supports obviously the stable margins, as net income has been increasing at a compound rate of 31%. So again, expenses are justified. They are driving growth. There is tight costs are spent when needed to drive both growth in the top and the bottom line. So I am happy with that. Looking at the ROE, the return on equity, Synopsys returns 14%, all right, which is below the industry average of 26%, but again, not a bad thing because invested capital satisfies, it is satisfying, its performance, considering that it is returning some form of return on invested capital. So happy with that. So overall, Synopsys is a fantastic financial performance. It has diversified revenue streams, healthy, stable margins, fair returns, and above industry growth in expenses are justified because they're driving profit at the top bottom line and realizing stable margins. Okay, now going to the financial position, you look at the current ratio, which has been fairly-ish stable. Now the stability is mainly driven by the, $1.6 billion in cash it has on its balance sheet. Below industry average, but not a bad thing, looking at the fact that it has been improving and it has been fairly stable. Not such a bad thing, I see Synopsys as fairly liquid. Looking at still not with the current ratios. You have to understand that liabilities for Synopsys are mainly driven by deferred revenue. Now, this is income that was received in advance. So, for example, before you perform a service or you supply a customer with a product, they pay you in advance. Now this helps with cash flow. Considering you don't have to wait till months and months after you supply the product or the service. You do have cash in the meantime to fund operations, to fund expenses, so you don't run into a cash flow problem or don't have a hole in your cash flow. So it's basically interest-free loans. It improves financial performance and lowers the financial risk. Um, so when I look at the asset test ratio, again, below the industry average, the industry average is about 1.88, but satisfying, considering that still above 1. It shows me that Synopsys does have enough short-term liquid assets to settle short-term liquid liabilities. And again, remember, liabilities are mainly driven by deferred revenue. So now both these liquidity ratios, as we talked, they are below the industry average, but they do indicate a company that's in a satisfying liquidity position. So they do indicate a company that is in a satisfying liquidity position, maybe below industry average, but again, not a bad thing considering what drives the liabilities. And furthermore, Synopsys does have enough cash on the balance sheet. A ton of cash, 1.6 billion. And looking at the ratios, they're above 1. It is able to meet short-term liability as and when they fall due with enough short-term liquid assets. Now, quickly moving on to the inventory days. Inventory days are very good. They are outperforming the industry average. The industry average is 101.39 days, 101.39 days, or just over 101 days. Synopsys on average holds stock for 84 or 85 days, just over 84 days. So it is a good thing, considering most of its peers hold stock for over 101 days, whereas Synopsys only holds stock for about 85 days. Again, considering its business model and the nature of its business, it mainly supplies the software and uses the IP, so you don't expect it to have that much stock. But again, a good thing, because below industry average, in this case, below for inventory days below industry average is very good. So a below industry average is pleasing. It's good because again, it highlights the liquidity of the balance sheet. Synopsys does not have a lot of liquid assets being inventory on its balance sheet. So when you read the current asset, the asset test ratio, as well as the inventory days, it proves a company that's in very good liquid position. It has good inventory management because it doesn't hold stock for longer than the industry average. There's a lower risk of stock being obsolete because you don't hold stock for that much. There's a less of a burden on your net income margin, considering the less stock you hold, or the shorter you hold stock, the less stock you're going to have to pay on holding costs. So overall liquid company outperforming in terms of inventory days, happy with the liquid balance sheet. Debt to equity below the industry average. The industry average is about 126%. Synopsys on average is about 62%. So this is very good. This is very good because it highlights to me that Synopsys in relation to the industry has less financial risk and has enough capacity on the balance sheet to increase debt should it need to fund operations and to fund expansion and growth. Now, again, remember the debt for Synopsys is mainly driven by the deferred income, which again basically interest-free loans and are needed to plug a hole in your cash flow to make sure you don't run into cash flow problems. So, considering the fact that debt is mainly driven by interest-free loans, which is deferred revenue, this ratio for me is much better than what it looks. It highlights to me Synopsys has a very, very, very low financial risk. So again, very healthy balance sheet that is liquid, not highly geared, so not substantially financially risky, very good inventory management, and substantial debt capacity that can be grown because it only has 62%. The industry average is 126%. So we still have a lot of debt capacity to grow debt if needed without actually adding significantly to the financial risk on the balance sheet. So very good. The cash position. First of all, the cash from operations margins has significantly improved. 24, 27, 36%. Overall at 39% below industry average. But I love the fact that it has significantly improved. Synopsys has been significantly improving, growing its ability to convert revenue into cash. At 2021, we're sitting at 36%. The industry average for a whole is 32%. So at 2021, Synopsys is performing above the industry average. But overall, it's below. Again, not a bad thing. It's been improving its ability. It does indicate that Synopsys business model is a very good business model. It's a business model that can generate cash from operations. I love it. Sufficiency of cash flow on hand has been improving. It's actually above the industry average. The industry average is 0.84. So it's above the industry average. That is very, very, very good. So on average, Synopsys has more cash from operations to settle, to settle, activities such as, paying off debt, but doesn't pay off that much considering, the debt is deferred revenue and income received in advance. So it does have enough to do that. It does have enough to pay back shareholders and does have enough to buy capital assets needed to grow the entity. So this sufficiency of cash flow is above the industry average. It's been improving. It is very, very good. It is very pleasing. It's very satisfying from an investor point of view. The buyback ratio, below the industry average. If you look at the average over the past 2 years, from 2019 to 2021, it's 39%. The industry average is 46%. But you can see Synopsys has from 2019 to 2021 grown how much it returns to shareholders. So, considering the fact that Synopsys is growing both the top and bottom line on the income statement, it's been growing its ability to generate cash flows. It's been improving its liquidity position. Doesn't hold that much debt. Yeah, you understand why it pays that much. It's actually rewarding shareholders for having faith in the company. But at the same time, it's an efficient use of cash. It's not just letting cash burn a hole on the balance sheet, but rewarding some cash effectively to shareholders. So the cash management as well as the cash liquidity point of view, Synopsys can generate cash from its operations and has enough cash generated from these operations on a yearly basis to fund all operations. However, the PE for me at almost 60 is high considering the industry average is 40. However, Synopsys is a good company. You will see, over the past year, performance has been really bad, but there has been a massive correction on the Nasdaq as well as the New York Stock Exchange. There has been a massive correction. I actually like this correction, because at 60 the PE is too high for me. But I mean, it is a good company. It's a very, very, very good company, but the PE is just too high. Yes, you're getting a lot for what you're buying, but the PE to me is just